Silver just split into two realities. On paper, it's one price. On the street, it's another. And the gap between them isn't small anymore. It's the kind of gap that only shows up when something is starting to break. Because right now, the official silver price you see on Western screens sits around $71 an ounce. But in parts of Asia, physical silver is already trading in triple digits. Japan is around 130, Kuwait is about 106, China is reportedly over 100. So ask yourself this, how can the same metal have two prices at the same time? That contradiction matters to you because when markets lose one price, they don't just lose a number. They lose trust, they lose predictability, and they lose control. And once that happens, the next problem isn't profit, it's delivery. Because the moment someone demands the real metal, the entire system has to pick a side. What you're watching isn't just a silver rally, it's a split-screen moment. One side is the financial market, clean charts, smooth pricing, liquidity. The other side is the physical market, real buyers, real metal, real shortages, real panic. And the trigger is simple. The official Western pricing system still acts like silver is just a number you trade. But the physical world is treating silver like a strategic asset you secure. That's why you're seeing something rare, the paper price and the real world price drifting apart like they're not even connected anymore. Now here's the framing that changes everything. This isn't an isolated glitch, it's a pattern. A signal that the market is starting to choose between two versions of reality. Because when the price on the screen is lower than the price where the metal actually exists, it creates one obvious question. Who gets the metal first? And the moment that question enters the room, everything changes. Investors don't just trade, they rush to convert. Dealers don't just quote prices, they ration. And the entire system shifts from price discovery to survival mode. So the real story isn't silver is up. The real story is what happens next when people stop trusting the screen. Here's the strong claim. The silver market is no longer being driven by demand. It's being driven by fear of non-delivery. Because if silver was just expensive, the prices would move together. You'd see the same number everywhere, give or take a little premium. Normal, predictable, but that's not what's happening. What's happening is the physical market is saying, pay more if you want it now, and the paper market is still pretending the metal is abundant. That's a dangerous contradiction. And the content gives you the clearest proof. Western pricing is still sitting near $71, while physical is trading in triple digits across multiple countries. That's not a premium, that's a separation. A decoupling so wide it looks like two different products. Now notice what's missing. You don't see a clean explanation. You don't see a calm bridge between these numbers. You don't see the reassuring message that supply is fine, because you can't reassure your way out of a shortage. And once the market starts whispering catastrophic decoupling, it's not talking about a metal anymore. It's talking about the mechanism that sets prices for everything else. Now watch how fast this escalates. Because once a market breaks into two prices, it doesn't politely return to normal. It usually does one of two things. It either snaps back violently or it shatters forward. And silver is a perfect candidate for that kind of stress test because it sits in a weird place in the global system. It's treated like a commodity, it trades like a financial asset, but it behaves like a survival resource when the world gets nervous. We've seen versions of this before, not with silver exactly in this form, but with anything that has a paper world and a physical world. When pressure rises, the paper side keeps offering convenience. The physical side starts demanding proof, and suddenly the price isn't what a chart says. The price becomes what it costs to get it delivered. This is where the story flips, because the longer this decoupling stays open, the more it teaches buyers one brutal lesson. You can't eat a contract. You can't manufacture with a promise. You can't hold something in your hand if it never shows up. And that's when the market stops being a market and becomes a race. Here's the part that should permanently change how you see this. The biggest signal isn't that physical silver is expensive. It's that the official price still exists at all. Because if real physical silver is trading in triple digits across major markets while the screen price stays dramatically lower, then one side of this system is absorbing the stress for the other. And that creates a contradiction that only lasts until someone forces a resolution. Think about how this works in real life. If you walk into a store and the shelf price says one number, but at the register they demand another, you don't call that market volatility. You call that a breakdown. And that's what this looks like, just scaled up into a global commodity that sits underneath supply chains, industry, investment, and financial confidence. Now notice what they didn't deny. Nobody is saying there's no problem. Nobody is saying delivery is guaranteed. Instead, the language gets sharper. The tone gets more urgent. Words like catastrophic show up for a reason. Because the moment enough people stop treating silver as a tradable idea and start treating it as a scarce object, the price doesn't just rise. The system changes, and then the pressure starts stacking fast. First, the gap itself becomes a headline inside the market. People who normally trade paper start watching physical premiums like a heartbeat monitor. Second, that gap pulls in a new kind of buyer, not the silverish shiny buyer, the I need delivery buyer, the buyer who doesn't care about the chart because they're not buying exposure, they're buying supply. Third, the system starts reacting in real time. Dealers don't behave like normal sellers anymore, they behave like gatekeepers. Availability turns into negotiation, speed turns into power. And once that starts, the market stops moving in one direction. It starts lurching. Because every buyer now has the same question in their head at the same time. If physical is already above 100 in some places, what happens if that number becomes the new baseline? What happens if the official price has to chase reality instead of leading it? What happens if this keeps spreading from one region to the next? What happens if this continues? Now bring it back to you, because this isn't just a story about metals traders. It's a story about what happens when the world quietly switches from pricing to prioritizing. When the screen price says one thing and the real world price says another, normal people get hit in ways they don't recognize at first. You feel it as higher costs, smaller margins, weird shortages, delays that make no sense. A product you used to buy easily suddenly becomes limited or back-ordered or available, but not at that price. And even if you've never bought a single ounce of silver in your life, you still live inside the world silver touches. Manufacturing, electronics, supply chains, industrial demand, the hidden stuff behind the stuff you buy. This is how a pricing crack becomes an everyday problem. Not through panic, through friction, through the slow feeling that everything is harder to get, harder to trust, and harder to plan. If this feels familiar, say so in the comments. Because the real question isn't, is silver up? The real question is, what else is about to split into two prices next? Here's the mechanism mainstream coverage usually misses. Markets don't run on truth, they run on coordination. As long as enough people agree to treat the screen price as the price, the system holds. Even if reality underneath it is shifting, even if physical supply is tightening, even if delivery is getting harder. That's the quiet leverage behind paper pricing. It creates a world where confidence matters more than inventory. But when physical prices spike far above screen prices, it exposes the weak point. The system is only stable as long as nobody calls the bluff. And that's why this story feels different. Because it's not just about silver being scarce. It's about silver becoming a referendum on how pricing works. The incentives are obvious. Paper markets reward speed, leverage, and scale. Physical markets reward possession, control, and timing. And when those incentives collide, you get exactly what you're seeing now. A gap so wide it can't be ignored. A split so loud it becomes a signal. And once a market becomes a signal, powerful players don't just react to it. They use it. Now we're at the part where the next move starts forming, because from here there are two paths forward, and both of them change the game. Path one is the snapback. The screen price rises aggressively to chase reality. The gap narrows. Headlines call it a rally. People cheer or panic. But the deeper story is this: the paper market is admitting it can't hold the line anymore. That's one possibility. Path two is the break. The gap doesn't close smoothly. It widens. Physical becomes its own market with its own truth, and paper becomes something else entirely, a prediction engine that fewer people trust. And if that happens, the market won't feel like a normal cycle. It'll feel like a regime change, because a world with two silver prices becomes a world where contracts, screens, and official numbers lose their authority faster than anyone expects. And you can already see the momentum building, not certainty, momentum. Because the next question isn't will this happen, it's who moves first before everyone else sees it. Here's the insight that stays with you. Silver isn't the story. The story is what happens when reality stops obeying the screen. When the official price says 71 but real metal trades above 100 in multiple places, the market isn't just sending a signal about value, it's sending a signal about control. And once control slips in one place, it rarely stays contained. Because every system like this depends on one fragile assumption, that the numbers we're shown still represent the world we live in. If that assumption breaks, you don't get one shock, you get a chain reaction. So the real question now isn't whether silver goes to 80, 90, or 150. The real question is what happens when enough people decide they don't want the paper version anymore. Because the moment that switch flips, markets stop behaving like markets. They start behaving like exits. If you want more breakdowns like this, fast, clear, and ahead of the curve, follow and subscribe. And in the next video, we're going deeper into the next asset where one price might not survive.